Welcome everyone, and thank you for joining us today for our session on Associations Liability, the Essentials, our final webinar for 2025. I'm Valerie Kewen, Senior Underwriter at Berkeley. Presenting with me today we have Melissa Lacey and Joe Horton, also Financial Lines with us. Next slide, please. Before we start, obviously today's session, just a few housekeeping things to cover. Today's webinar will be recorded, so you will be able to review it at a later date on our website. The link will also be sent to you in the next few days. It should be up on the website by the end of the week. During the session, obviously, we do invite your comments and questions. There is a Q&A section on our screens. Throughout the session, we will have a couple of polling questions as well via Slido. When the questions for that pop up on your screen, you can add in your answer and we will give you a few minutes to get some answers together. If you're having any technical issues with sound, please try disconnecting and reconnecting, or use the call-in number that's provided in the audio options on your screen. If you cannot see the presentation, please make sure you're using the WebEx app rather than a browser, or you're outside of your company's server. This presentation also allocates CPD or CIP points. A certificate will be emailed to you later this week, and you can also claim points online via either the NEBA or ANZIIF website. Next slide, please. Here's what we'll be looking at covering for you today. First, we're going to unpack what association liability is. What does it cover? We'll explore the breadth of cover it provides, and then we'll look at who it's designed to protect, from committee members right through to the entire organisation. We'll also dive into why association liability matters, and including the key considerations for both brokers and underwriters and clients alike. Next, we'll explore some of the common exposures, both specific to association and some common exposures with other policies, as well as walk through specifics of the association liability policy. We're going to do a quick simplification of the key differences between association liability and management liability so that you confidently can guide your clients in the right direction for their purposes. And finally, we'll share some real-world claims examples that will bring the cover to life for you. Let's get started, and I will hand over to Joe. Thanks, Joe.
All right, next slide, please. Thanks, Val. Hello, everyone. Let's kick off with the basics. So what exactly is association liability? At its core, association liability is a multi-line insurance solution, and it's designed specifically for not-for-profit organisations, sporting bodies and community associations. It's built to protect both the entity itself and the individuals who run it, so directors, committee members, employees and even volunteers. Unlike standard commercial policies, this one's tailored to the unique risks that these groups face. It combines elements of directors and officers liability, entity liability, employment practices liability, crime and fidelity cover, professional indemnity, statutory liability, and even defamation and IP infringements. So it's just not one type of cover, it's a comprehensive safety net for organisations doing important work in our communities. Whether it's a national charity, a professional association, or a volunteer-led community group, association liability helps ensure that they're protected from the legal and financial challenges that can arise unexpectedly. Next slide, please. All right, so association liability is designed to support a wide spectrum of organisations, so each with its own unique risk profile, governance structure, and operational purpose. Understanding these nuances is essential for effective underwriting and risk management. Let's start with professional associations. These are organisations formed to advance a particular profession, often with dual responsibilities, so serving their members and upholding standards in the public interest. A great example that we should all be familiar with is ANZIIF, which supports professionals in insurance and finance through education, networking, and advocacy. These associations tend to be well structured with clear governance frameworks, and defined objectives. They're making them a strong fit for association liability coverage. Their risks are typically centred around professional conduct, member disputes, and reputational exposure. Next, we have the community sector, a core focus for many financial lines underwriters. These organisations include local community groups, cultural associations, and volunteer-run initiatives. They're often low risk and purpose driven with limited financial exposure and a strong emphasis on social impact. So while their governance structures may be less formal, their intent is clear and claims tend to be infrequent. That said, even small groups can face challenges around member disputes, defamation, or procedural fairness, making association liability a valuable safety net. Then there's the aged care sector. So while aged care associations can be considered for coverage, this space has become increasingly complex. The Royal Commission into Aged Care Quality and Safety, coupled with the impacts of COVID-19, has heightened scrutiny and regulatory pressure. Governance failures, reputational damage, and compliance breaches are more likely to arise, which means underwriting this area requires a cautious and informed approach. Risk selection, policy wording, and claims history all play a critical role. Ultimately, the suitability of association liability hinges on three key factors. The structure of the organisation, so how it's governed and who makes the decisions, its purpose, whether it's professional, charitable, community-based, or advocacy-driven, and its exposure to governance disputes, professional services liability, and reputational risk. By understanding these elements, our underwriters can assess which associations align with our standard product offerings, ensuring appropriate coverage is available where it's needed most. While we don't tailor policies, our off-the-shelf solutions are designed to meet the common risks faced by a wide range of organisations. Next slide, please. All right, so now that we know what association liability is, let's talk about who it actually protects because it's more than just the boardroom. First up, we've got the association itself, which is the legal entity. If someone sues the organisation directly, this policy steps in. And then there are the directors and office bearers, so the people making the decisions and steering the ship. Whether it's a formal board or casual committee, they're covered for alleged wrongful acts in their roles. Committee members are also protected. Even if they're volunteers, they can still be held personally liable for decisions or oversights. Employees are automatically covered, and let's not forget volunteers as well. They're often the backbone of these organisations, so yes, they're covered too. Finally, the policy extends to the professional services provided by the association. So if the group offers advice, training, or other services, there's protection against claims of negligence or breach of duty. So in short, it's a wide safety net and it's designed to protect the people and the purpose behind the organisation. Next slide, please. All right, ladies and gentlemen, we've come to the first interactive moment in the presentation, so it's your turn to participate here. The question will appear on the right-hand side of your screen. However, if you are experiencing issues, please scan the QR code on the screen and enter the passcode to cast your vote. Our first Slido question for you today is, what is the most common type of claim notification received under an association liability policy? So we've got 4 options for you to choose from. So option A is breach of constitution or rules. B, employment practices liability. C, mismanagement of funds, or D, defamation. All right, so just take a moment to consider each one. These categories reflect the kinds of real-world challenges associations face, often unexpectedly. And to help guide your thinking, here's a few quick snapshots of what each might involve. So for example, a breach of constitution or rules could be removing a member without following proper procedures. Employment practices liability, this could include claims of unfair dismissal, discrimination, or harassment. Mismanagement of funds, such as a committee member misusing association funds. And the last one, defamation, I think damaging statements made about a member in a newsletter or during a meeting. These type of claims can arise and even in the most well-intentioned organisations, and understanding them is key to appreciating the value of association liability coverage. We'll give you a few moments here to get your votes in, so there's no rush, but once we have the results, we'll reveal the correct answer and give you a snapshot as to why it's so common in practice. Just give you a couple more seconds there. All right, hopefully we've given everyone enough time to get their answers in. I think we'll pause it there. All right, so the correct answer is B, employment practices liability, and it's good to see just about half of us chose that one as the answer there. So this type of claim consistently tops the list, and it's not hard to see why. Associations, like any workplace, are vulnerable to disputes involving staff and volunteers. Allegations of unfair dismissal, discrimination, or harassment can arise even in the well-intentioned environments, and when they do, they often carry significant legal and reputational consequences. Employment-related claims tend to be complex, emotionally charged, and highly sensitive, and they can involve multiple parties, conflicting accounts, and a need for careful handling to preserve relationships and minimize exposure. From an underwriting perspective, this category highlights the importance of clear HR policies and procedures, documented grievance handling processes, and training for committee members and staff on workplace conduct. It also reinforces why association liability coverage is so critical, providing protection when internal disputes escalate into formal claims. Thanks for jumping in. Your responses help bring in these concepts to life, and we'll keep the momentum going with another interactive portion to come, so stay tuned and keep your devices handy. Next slide, please. All right, when assessing association liability risk, there are a few key factors that we always look at, and they can make a big difference in how we rate, structure, and underwrite the policy. First, we'll start with the type of association. Is it a formal professional body, a community group, a charity, or something more complex like a union or an aged care provider? The nature of the organisation sets the tone for exposure. Next, we consider professional services offered. Are they giving advice, running training programs, or offering support services? The more public-facing or advisory their role, the greater the potential liability. Volunteer involvement is another big one. So many associations rely heavily on volunteers, but we also look at the number of employees and contractors, especially if they're delivering services or managing operations. Then there's turnover and funding sources. Is the association government funded, member funded, or donation based? This helps us understand financial stability and potential reputational risk. We also assess the limit of indemnity required. So some associations need higher limits due to their size, scope, or contractual obligations. From there, we look at any extensions or exclusions being requested or required. Tailoring the policy to fit the organisation's needs is key, but we also need to manage exposure. And finally, we review the claims history. So past claims give us an insight into risk management practices and potential red flags. All of these elements help us build a clear picture of the risk and ensure the policy is fit for purpose. Next slide. Alrighty, incorporated associations and or not-for-profit entities all have varying degrees of exposure to consider depending on the industry and sector in which they operate. As we touched on in our Slido question, some consistent exposures can include employment practices liability, which can incorporate both allegations against the directors or insured entity by current employees, as well as those who have failed to secure employment in the insured organisation. Fidelity can be a significant exposure if the entity operations include product sales, particularly those involving cash sales or sales with limited supervision of staff. If the insured is a trade or professional association, their operations can have a significant professional indemnity exposure, particularly if a portion of the insured services is to provide training or professional education to its members. Office bearers and or directors are responsible for the management of the insured organisation. So similar to a D&O cover, the association liability policy will provide protection for the office bearers in the event of allegations of inappropriate management and or operational decision making. Defamation is another potential exposure, particularly for associations that publish newsletters, reports, or online content, or engage in public commentary. Allegations may arise if a third party claims that published material has damaged their reputation. Even if unintended, such claims can lead to costly legal proceedings and reputational harm, making defamation coverage an important consideration for entities with a public-facing communication role. Next slide, please. Here's what's included in a Berkeley Association liability policy. So it goes well beyond a standard D&O policy and is purpose-built for the unique risks faced by associations. Starting with the core coverage over on the left-hand side there, you'll see office bearers liability. This protects directors, committee members, and other office bearers against claims of wrongful acts in their roles. Think mismanagement, breach of duty, or misleading statements. Next one down is association liability. This covers the entity itself for claims made directly against the association, whether from members, regulators, or third parties. We've got professional indemnity. If the association provides advice, training, or other professional services, this kicks in to cover claims of negligence or breach of duty. Appointed sub-consultants. We extend cover to consultants engaged by the association, provided they're acting within the scope and under the association's direction. Dishonesty of insured persons. Covers financial loss caused by fraudulent or dishonest acts committed by employees, committee members, or volunteers. Continuous coverage. If the insured forgets to notify a claim during the policy period but had prior cover with us, we may still respond, subject of course to terms. Defence costs. Legal defence costs are covered even if the claim itself isn't ultimately successful. This is often where the biggest expenses lie. And then on the right-hand side there, now for the optional extensions, which can be added based on the association's needs. We've got fidelity cover for losses due to internal fraud or theft. Employment practices liability covers claims like unfair dismissal, harassment, and discrimination. We're all experts on that now that we've done the Slido question. And tax audit costs, which help cover the cost of responding to an ATO audit, which can be time-consuming and expensive. So whether it's protecting the people, the entity, or the services they provide, this policy is designed to be comprehensive, flexible, and practical for real-world risks. Next slide, please. All right, let's take a moment to unpack some of the technical mechanics behind association liability, because understanding how the policy responds is just important as knowing what it covers. First off, association liability is written on a claims made basis, which is not occurrence. That means that the policy is triggered when a claim is made during the policy period, regardless of when the actual wrongful act occurred. Timing is everything here. This brings us to the retroactive date, a key feature. So only acts, errors, or omissions that occur after this date are covered. Anything before it, not included. So it's important to check this date carefully when reviewing terms. We also include continuous cover clauses, which provide protection for late notifications. This is particularly helpful if the insured has been continuously covered with Berkeley and simply missed a reporting deadline. Now let's talk about limits of indemnity. These are usually structured as any one claim and in the aggregate. That means that the insurer will pay up to the stated limit for each claim, but there's also a cap on the total amount payable across all claims in the policy period. Reinstatements may be available to increase the aggregate limit. And finally, a key distinction brokers should understand is defence costs can be either in addition or inclusive of the limit. A cost exclusive or cost in addition, as it's sometimes called, limit means that legal defence costs are paid on top of the indemnity limit, which is great for preserving the full amount for settlement. A cost inclusive limit means that the defence costs and compensation are drawn from the same pool. So there's a total payout. So the total payout is capped at the stated limit. These structural details can significantly impact how the policy performs in a claim scenario. So it's worth making sure that your clients understand the difference. And from here, I'm going to hand you over to Mel. Thanks, Mel. Well, Mel, I think you might be muted.
Sorry, me and technology. Sorry about that. Association liability versus management liability. While association liability and management liability may appear similar at first glance, they're actually designed to serve fundamentally different types of organisations with distinct risk profiles. Management liability is designed for commercial businesses. Think companies with paid staff, shareholders, and operational risks that are tied to profit-making activities. The exposures here are typically around corporate governance, employment practices, and regulatory compliance. On the other hand, association liability is purpose-built for not-for-profits. These organisations often rely on volunteers, have limited resources, and exist to serve a cause, not the bottom line. Their key exposures include governance advocacy, professional advice, and reputational risk. So while both policies offer protection for leadership and the entity, association liability is tailored to the unique challenges faced by community-driven organisations. It's not just a scaled-down version of ML, it's a different mindset altogether. Next slide, please. Okay, now for round 2 of today's interactive segment. Time for another Slido. Just like before, the question will appear on the right-hand side of your screen. However, once again, if you're experiencing any issues, please scan the QR code and enter the passcode to cast your vote. This one is a simple yes or no answer. Can an association liability policy be held under an insured's trading name? I'll give you a few moments to answer the question. Okay, we might pause it shortly. Yep, we might pause it there. Thanks, Chelsea. Okay, it looks like majority of you got the answer correct. The answer is actually no. An association liability must be issued in the name of the legal entity. A trading name can be noted up for reference, but coverage applies to the legal entity behind it, not the trading name itself. If the trading name is properly registered and linked to the insured name, it can still be noted on the policy schedule. Okay, next slide, please. Right, now for some real-life claims examples that highlight the importance of association liability coverage. These examples demonstrate how reputational and governance risks can arise in unexpected ways, and how timely intervention and strong policy wording can make all the difference. Our first case involves a defamation allegation stemming from a LinkedIn activity. The insured, a professional association, had posted content promoting professionalism and dispute resolution process in the strata sector. These posts were followed by comments from a third party, which included a link to an article critical of the claimant's business. The claimant alleged that these interactions amounted to a personal attack on them and their business, and questioned whether the insured had breached their fiduciary duties by allowing such commentary to appear alongside the insured's posts. Although the association hadn't authorised or endorsed the defamatory content, the potential reputational risk for the insured was significant. This case raised several concerns. First, the allegation of defamation and the perception that the insured's LinkedIn activity had facilitated and endorsed the damaging statements. Second, it raised questions about governance. Had the officers acted in line with their statutory and fiduciary duties? Third, the reputational risk. The claimant was a high-profile industry figure, and the situation threatened the association's credibility and undermined confidence in the insured's impartiality. And finally, the challenge of managing social media platforms where third-party comments can create ambiguity around who has endorsed them. Berkeley Insurance confirmed indemnity under the association liability policy and referred the matter to panel counsel. The advice was clear. The insured should firmly state it had no connection to the third party or their publication, and it should clarify that its own posts were made in good faith and consistent with its roles in promoting industry standards. Panel counsel prepared a detailed response rejecting demands for a public apology and further public statement. It was advised that all posts were removed to mitigate any ongoing risk, which they were, and the matter concluded without litigation or indemnity payment. This case underscores the need for robust social media governance. Even well-intended posts can be hijacked by third-party commentary. Associations should implement tighter moderation controls, document internal protocols for public communications, and train officers on defamation risk and fiduciary duties. From an underwriting perspective, it highlights the value of formal media policies and rapid response strategies to contain reputational threats before they escalate. On to our second case, which involves a professional association accused of mishandling a grievance process. The claimant, a member of the association, alleged breaches of duty and procedural fairness under Section 50 of the Associations Incorporations Act. For those who aren't familiar with Section 50, it refers to and requires incorporated associations to follow the rules of natural justice when resolving internal disputes. This dispute began when a finding that the claimant had breached the association's code of ethics, and there was a recommendation of supervision for the claimant. However, after an appeal by the claimant and procedural missteps, including onerous communication from an appeals panel member, the original findings were overturned. The claimant then sought $78,000 in compensation for emotional distress and financial loss. This matter raised several key issues. Alleged breaches of natural justice and procedural fairness, governance concerns due to the prolonged 18-month internal investigation and appeal process, emotional distress claims by the claimant, raising questions about the applicability of the bodily injury exclusion, unsubstantiated financial loss, and the risk of reputational damage and litigation if the matter escalated. Indemnity was extended under the policy, triggering the insuring clause wrongful acts, with a reservation of rights regarding the bodily injury exclusion. Panel counsel was appointed, and the legal strategy focused on responding to the allegations while highlighting the weakness in the actual claim. Thanks to early intervention, the claimant was dissuaded from pursuing the matter further. The total cost incurred ended up being $15,000, which was far less than if the dispute had escalated. This case highlights the importance of clear, timely and procedural sound grievance handling. Associations should ensure appeal panel members are properly trained, document and rigorously follow internal processes. From an underwriting standpoint, it reinforces a need for insurers to understand coverage limits, especially around emotional distress and financial claims. And once again, early intervention proved critical. Next slide, please. Okay, our third case centres on a governance dispute involving 3 former council members who were suspended following a disciplinary proceeding. Allegations included breaches of the association's constitution and rules, such as one of the claimants misrepresenting a residential address to meet eligibility requirements, and broader misconduct concerns tied to social media use and internal governance. The claimants argued that the disciplinary actions were unlawful and sought reinstatement of their positions, declaratory relief and damages. This matter underscored the delicate balance between enforcing organisational rules and ensuring procedural fairness, especially when personal reputations and governance obligations are at stake. The key issues of the matter included whether the insured acted within its constitutional and legal obligations. There were claims of flawed disciplinary processes and denial of procedural fairness, concerns around privacy and the monitoring of private communications, the potential exclusions under the policy, which were fraud, dishonest act and contractual liability, and reputational risk due to seniority of those involved and visibility of within the association's community. Berkeley Insurance granted indemnity under the association liability policy, subject to the reservation of rights regarding the exclusions for fraud, dishonest acts and contractual liability. Panel counsel confirmed the matter constituted a wrongful act and recommended early mediation to contain costs. The insured followed legal advice and the matter was resolved without litigation. Had the matter escalated, the potential cost of the claim could have got up to around $250,000. This case highlights the importance of transparent disciplinary procedures and consistent application of the rules, respecting privacy boundaries and acting within clear authority, formal governance training for council members, early resolution strategies like mediation to manage costs and reputational fallout. From an underwriting perspective, it reinforces the need for strong governance frameworks and proactive risk management. Excuse me. And on to our final case, which involves defamation brought by a former member against the insured association. This dispute began when the complainant raised concerns with governance issues. Such allegations included accusations that the insured was operating under an unregistered name and constitution, and there were also inaccuracies in the financial reporting. Tensions escalated around the time of the AGM, which was deferred following board resignations. The claimant alleged defamation after a resignation letter circulated amongst members, claiming it contained damaging statements. The situation quickly became complex with multiple parties involved and potential counterclaims raised. Key issues included alleged governance failures and breaches of the Associations Incorporations Act, defamation claims tied to internal communications and shared with club members, the potential for counterclaims and the need to manage multiple people with differing legal positions, uncertainty around indemnity due to mixed governance and defamation allegations, and risk of escalating legal costs. Although the defamation claim was considered weak, the claimant was persistent and well-resourced. Panel lawyers were appointed and the strategy focused on de-escalating and managing the indemnity exposure. After extended negotiations, a settlement was reached of $15,000 without any admission of liability or public apology. The settlement included a confidentiality clause and all parties agreed to release each other from further claims related to the dispute. Lessons to be learnt from this case include the need for legally sound and transparent governance and communication practices, the importance of managing multi-party disputes with structured defence strategies, the value of early intervention to contain claims costs and resolve matters efficiently. Through an underwriting lens, the case reinforces the importance of clear policy wording and strategic claims handling, especially when reputational and governance risks interact. Next slide, please, Chelsea. Thank you. So after hearing what you've heard today, why does association liability matter? Association liability isn't just a nice to have. It's a critical safeguard for organisations that often operate with limited resources, volunteer leadership and high public visibility. Groups such as charities, advocacy bodies, professional associations face genuine risk. Unlike large corporations, they may lack the internal infrastructure to effectively manage legal, financial, or reputational challenges. Claims can come from members, employees, regulators, or third parties, and they don't need to be malicious or intentional to cause serious disruption. A simple governance misstep, a poorly worded public statement, or an employment dispute can quickly escalate. Without the right cover in place, these organisations can face costly legal defence bills, personal liability for community members, loss of funding or reputation, or operational shutdown. Association liability matters because it provides peace of mind, protecting the people who give their time, the entity that serves a community, and the mission they're working towards. It's not just about insurance. It's about enabling these organisations to keep doing what they do best without the fear of financial ruin from one single claim. I'll now hand back to Val, who will answer some of the questions that have been raised through the Q&A. Thank you.
Thanks, Mel. Some of the common questions that I get asked, not necessarily from the Q&A section, but with association liability being a combined, obviously, D&O PI type policy, is can we just purchase one section? The answer is no. Association is a packaged policy, and it's a package for a reason, because it's obviously rated and tailored specifically to meet the needs of these not-for-profit type entities. If you are just after a separate D&O or PI cover, then those standalone products would be more appropriate. Another common question that I do get asked is, does the association liability policy include public liability? Under the Berkeley offering, the answer to that is no. A separate standalone liability policy would be required to cover that particular exposure. In terms of Berkeley's retroactive date policy, we are happy to match the retroactive date that's on an insured's existing policy if it's a piece of new business to us. The other question that is a very common question is 99% of the time association liability is quoted with a costs inclusive limit and excess. The reason behind that is that 99% of the claims costs are actually just legal expenses for an association liability claim. It's more common than not that a claim will incur defence costs and there'll be no final settlement at the end. There's a couple of other questions just popping up on the Q&A now. What is our maximum limit for an organisation's site? There is no specific turnover limit, and we can provide indemnity limits of up to $20 million. So we have quite a broad appetite in that respect. Another question there. Are we able to get a copy of the presentation? Yes, it will. A link will be emailed to you. Is there a difference in cover or limitations / exclusions on association and those not on ML? There are some differences. Obviously, the management liability is more tailored for a professional corporation. So there are additional coverages such as workplace health and safety, statutory liability, which is a little bit more broad than the fines and penalties cover that you would receive under an AL policy. Typically, a management liability obviously is providing additional cover benefits in terms of the management of the organisation and the regulatory claims that can arise. So those are rated probably at a slightly higher rate than an association policy. But again, that depends on the particular risk and its individual history. Looking through, that seems to cover the majority of the questions in the Q&A section. One that did crop up was how are claims quantified by a claimant if they are actually a volunteer and not earning wages? Now, I don't know the answer to that at this stage, but I can find out. But it's not necessarily a quantifiable claim. It could just be an initial allegation that requires an investigation, in which case defence costs may be provided to the insured. But they can still obviously make any types of claims along the lines of harassment or unfair dismissal from their role, regardless of not actually being paid a wage. I think is there a difference? I think that is covering the most of the topics on the Q&A section. So just a few, obviously, shameless plugs before we finish up for today. Berkeley have obviously just launched, as some of you may be aware, the Broker Learning Hub via our website. So this is a way for you guys to contact us to get a better understanding of some of our products and appetite. We have a range of courses that all include CPD or CIP points, which can be delivered to you in person or virtually. Training sessions can also be specifically tailored to suit your team's needs. So please jump onto the website, look through the Broker Learning Hub, and you can book a session with your local underwriter to go through anything that you may require. Next slide, please. And even better, those of you who have attended today have been entered into the draw to win the Ultimate Concert Experience. One lucky winner will receive a VIP ticket in the Berkeley Insurance Australia box to see Lady Gaga live in Sydney on December the 13th. Return flights and accommodation included. And as this is the last webinar of 2025, that is the last opportunity for you guys to enter. So good luck and congratulations to the winner. Thank you so much for joining us today. If you can just cast your eyes across the top of the screen there, we have a disclaimer which basically is just pointing out that this information is current as at today's date. Information is obviously subject to change and the details are based on our existing Berkeley insurance policy wording. Thank you for taking the time to spend with us today, and I hope we've provided you with some useful information that you can share with your clients. If there are any additional questions or comments that you'd like to make, please feel free to reach out to your local underwriter, and we will just go through the Q&A section and just make sure that we have answered as many questions as possible. Any questions that we haven't answered, we will endeavour to respond to as soon as possible. Thank you so much for your time and have a lovely rest of your day.